Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I am your host, Bob Pisani. China stocks have been on a wild roller coaster ride in the last 2 weeks on hopes of stimulus in that country. But has the investment outlook in China really changed? Let's ask two China ETF experts. Dave Matza is CEO of Roundhill Investments and has just launched a new China ETF, and Jason Su is founder and chairman of Rayliant Global Advisors, which focuses on investing in China and emerging markets. Dave, you launched the Magnificent Seven ETF a year and a half ago. Boy, that was perfect timing. And last week, you essentially launched a China version of the Magnificent Seven ETF. I know you're calling it the China Dragons ETF, 9 of the largest and most innovative Chinese companies. I want to talk about that later, but despite these stimulus hopes that we're talking about in China, the stocks in China, the indexes are trading at the same levels they were 17 years ago, in 2007, 17 years ago with no gains. Is there any argument to be made that China is suddenly a better investment now than it has been in the last 17 years?
No, you're absolutely right. If you look in the rearview mirror, China's been a really difficult market to invest in. It's been dead weight in portfolios. To your point, it's really moved nowhere. But what's important to know about China is, again, it's the second largest economy in the world, second largest equity market in the world. So we don't believe investors should actually ignore this as part of an overall portfolio, particularly in light of the fact that the Chinese economy is certainly one that is dynamic and growing, but it faces challenges. What's different now is that the Chinese authorities at this point are putting in a huge amount of stimulus. To date, it's only been on the monetary side, focus on the stock market, but there's expectations for a lot more, especially on the fiscal side and the structural reforms that can really make this market more investable going forward.
Jason, the same kind of question to you. The S&P 500 is up 270% since 2007. China stocks, the indexes are essentially nowhere, zero. So can you explain to the viewers, why has China been such a disastrous underperformer on a global level? And is anything happening here, including these vague stimulus hopes, that would change that poor performance?
So Bob, first and foremost, this is the difference between an efficient market and an inefficient market. The U.S. is very efficient, so you're going to do just fine holding the Magnificent Seven, the S&P 500. But for China, you need to actively manage your portfolio mix, right? If you just buy the index, you will experience a lot of volatility, a lot of ups and downs, but really no positive trajectory. That's because you need to constantly rebalance your portfolio, aiming your portfolio in the direction of where the stimulus spending might be in a particular fiscal cycle, aiming your trajectory in where the industry is going. And there are very volatile industry rotations in China. Had you done all of that, you actually would have experienced quite a nice ride in a more actively managed portfolio. Now, talking about actively managing it in the direction of stimulus, I think Dave is absolutely right. The Chinese government is now spending 2 trillion renminbi in the first tranche, and it's expected to go up to about 10 trillion by the time they're all said and done. And in fact, they've signaled there's no upper limit to how much they'll throw at the economy to make sure it grows at a 5% real GDP target. And I think that's quite exciting, right? The government's telling exactly what it is going to do. And this Saturday, it's going to tell you, in fact, where the money is actually being aimed toward. And you just have to, in a way, follow the government's money, right? It's like we used to say, follow the Fed, don't fight the Fed. In this case, follow Beijing, don't fight Beijing. And I think you're in for a pretty good bull market ride.
You know, I appreciate what you said, Jason, but I still see this as a very tough sell. We had stimulus before in China, but we still have overall poor performance. And I think more importantly, China is perceived to be much less friendly to global investors because of the policies of Xi Jinping, the head of China. If you look at the investment landscape, the China consumer is overinvested in real estate. They seem underinvested in the stock market, and they're very heavily invested in personal savings. So it seems to me like we're going to need a lot more than stimulus. I mean, doesn't China seem to need a restructuring of the whole economy? But that seems like a tall order under Xi Jinping, doesn't it? I mean, there's something missing here, isn't there?
Bob, you're absolutely right. There are two things, right? And if you're focused just on the stock market, there's, of course, the dry powder, how much can be deployed, and what will it take to move all that money into the stock market. Right now, estimated they're about 20 trillion, and this is not renminbi, this is US dollar, 20 trillion equivalent in dry powder cash in the bank waiting to invest. The fact that they haven't invested is, of course, a confidence issue. So on the one hand, you got a lot of money, very weak confidence, but that could all turn into potential for the market. But Bob, I do want to talk about the other point you made, which is the underlying economy, right? Because ultimately, the stock market is more than just a confidence game, right? You do need the underlying economy to perform. And I think this is where there's a lot more wait and see, right? The government will spend money, throw money at it, but we know ultimately it can't be just government spending, right? There has to be really healthy, strong private sector investing from the corporate side and spending on the consumer side. And I think you're right, that remains to be seen. Is the stimulus big enough to kickstart a virtuous cycle? And we'll have to see.
I don't mean to keep belaboring this point, Jason, but what's going to change here? I mean, it seems like you need a fundamental restructuring of the economy. Xi Jinping does not like capitalism. That's what kind of the underlying premise here. How are you going to change this to suddenly make it a more investor-friendly, more open, more transparent? This seems to be going against everything Xi Jinping is telling us at this point.
Yeah, so I think, the one thing that I have a slight different view versus others looking at Beijing is, yes, Xi Jinping does, have his skepticism about the capital market, but he's also quite practical and wily, right? He did maneuver himself to the top position, not because he's inflexible and unintelligent, but because he's quite savvy and can pivot. And I think he's probably taken his licks and realized that, through Beijing's incredible effort, right? It has struggled mightily at managing the economy. It has to go back to what has worked for his predecessors, which is let the capitalistic competitive economy do its work for him. Because ultimately, for him to stay in power, to be the legitimate, grand leader, the economy has to perform. And I think he's tried one path, which is him micromanaging and working really hard and seeing almost no results. And I think he's now sort of recognizing, and it's just like COVID, right? His initial policy managing COVID was unsuccessful, and then he said, "I'm just going to open it up." I think he's hit that point where he says, "Look,
really,
the capitalistic competitive market is the way to go."
I'm impressed you're saying that. I don't necessarily know if it's happened yet. I mean, the problem here is that everybody, myself included, thought when Xi Jinping came in, we were going to get sort of another version of Deng Xiaoping, the great leader of the 70s and 80s who brought China out of the disasters of the 1960s and instituted limited amounts of capitalism. But we didn't. Instead of Deng Xiaoping, we essentially got Mao Zedong. And that's the problem the global investors are having. You're saying you think that Xi Jinping is starting to change? Is that your point here?
Yeah, because what we're getting from Beijing, right? Previously, Bob, you're absolutely right. He was dismissive of the stock market, thinking that in China, the stock market is more like a casino. So why should I care about what the stock market's telling me? But he was quite sort of micromanaging when it comes to real estate, thinking, he's going to contain the real estate bubble through sheer force of sort of taking apart these big construction companies. I think he's come to realize that it's a very delicate system, and this micromanaging doesn't work. It's been 3 years of him doing that, and the data is just telling him the old system works better. So I'm betting on the practical side of him is going to pivot.
I hope that you're right, but I'm still skeptical. Dave, chime in here. Somebody's wrong here. I know David Tepper of Appaloosa Management. He was on our air. He said he's buying everything related to China because of the government support, this stimulus supposedly that's coming. But we have other people. Ray Dalio says it's really difficult to invest in China because Beijing is seeking to structurally move the country away from capitalism. So somebody's wrong here, Dave. Your thoughts?
Yeah, no, I think, but you're hitting the nail on the head. The Chinese market has been full of controversy for good reason, because to your point, there was expectations of further broadening out and further opening up, and the opposite has happened. But I think Jason's point is a really good one, is that we're at the stage now where I think the authorities are recognizing the challenges that they have, and they need to pivot, they need to make changes. However, I do think investors who are looking at China need to be more cautious and careful. There's still a lot of risk. The smaller companies are very opaque. There's questions that actually about connectivity with state-owned enterprises and who actually owns what. And that was really one of the reasons and thesis is behind us launching China Dragon. There is a lot of similarities between those stocks and the Magnificent Seven stocks we have in the US. But for an investor looking at China now, precision may actually be a benefit to them because they know exactly what they're going to have, either large, mega companies, multinational companies with revenue streams that aren't necessarily as dependent upon the stimulus fully coming into place, even if we know it's happening, coupled with the fact that the Chinese market, and of course this has been the case for some time, is extremely undervalued relative to the broader globe, relative to the US, relative to the broader EM. So for an investor saying, hey, I can embrace controversy, I know the path may not be perfect, it could be volatile, but I'm actually buying stocks at a much cheaper price with the potential for outsized earnings going forward, which is one of the reasons why I think the Chinese market could come back.
All right, Dave, briefly, tell us more about this new China ETF. It launched last week. I mean, this seems to be based on the same principle as the Mag 7 ETF was based on a year and a half ago, but give us a brief summary of what that's about.
Yeah, so the China Dragons ETF, the ticker is DRAG, D-R-A-G, is focused just on 9 companies. And these are the companies that we identified as having similar characteristics to the Magnificent stocks in the US. And so that by that I mean not just that they're large and liquid, but they have high earnings growth, high revenue growth, moats around their businesses. And what we believe, like we've seen in the US, is a winner-take-all environment, whether that's AI, cloud computing, growth of the consumer. Names like Alibaba, names like Baidu, Tencent, Pinduoduo exhibit those characteristics, and that's why them and only them are in the China Dragons.
Okay. Jason, you also run a China ETF. I want you to explain a little bit about Rayliant's investment methodology. This is the first time Jason's been on ETF Edge, folks, so I want him to explain your methodology briefly. And for those who do want to invest in China, what should they be buying? Explain this ETF to us.
Thanks, Bob. So, what Dave just pointed out in his ETF, there are a lot of names that are listed in the US or listed in Hong Kong. My ETF, RACI, it's only the onshore shares, meaning these are stocks that global investors, Americans, can't just buy listed on the New York Stock Exchange. So these are the local shares, local names that you would have to be a local Chinese person to buy easily, or you have to register what is called a kind of a cross-border QFII quota stock connect to buy these shares. Okay, so these are the onshore shares. And generally, the onshore shares paint a very different story. When you look at what's traded onshore in China, tech is only about 11%. The other 90% would be in consumer, would be in white appliances makers, online, offline retailers. And so it paints a very different picture because China is sort of in a different part of its growth curve, right? Technology is important, but a lot of the higher growth stocks are actually people who sell water, people who run restaurant chains. So often they actually have a higher growth than even many of the tech names. And so we're trying to help investors get access to these names that are less familiar. There's very little research, at least outside of China. And they may represent what is more of a thematic, in the moment trade inside China that is, not known to U.S. investors.
Yeah, so I want to put up the list of what's in this ETF because it's interesting. The list is very diverse. Kuaichao Mutai, that's the famous liquor maker, right? That's like the biggest liquor manufacturer in China, right? Kuaichao.
Absolutely. Yeah. Mutai is, of course, the luxury alcohol in China, and it's about $400 a bottle. And when the economy is starting to kick into gears, it tends to be like a leading indicator when people start to consume these luxury alcohols because they're hosting big corporate parties, they're going out to dine. And so this is a great indicator of the economy turning around.
Right. And Ping An, of course, is a big insurance company. They bought stuff in the United States, too, a while ago, a number of years ago, right? Famously, right? Did they buy the Waldorf Astoria? Who owned Ping?
Yes, so Ping An is a big, it might be Ping An, one of its related subsidiaries. It's the biggest insurance company in China, heavily exposed to real estate in China. And so it's a way to play the real estate turnaround given the big government stimulus to stabilize the real estate sector.
So this is two different approaches here. I mean, Dave is basically tech companies that tend to list here in the United States too, and you have like A shares that are mainland China based. It's really sort of two different approaches. I guess the average viewer is sitting here saying, okay, I'm convinced I should put 5% of my portfolio in China. These are two completely different approaches to it, really. I'm just asking you.
Yeah,
you both notice this? A viewer would notice this, right?
Yeah, no, but I think what's interesting here is that even though we're saying in some ways what could be viewed as opposites, right? So Roundhill is advocating and creating an ETF that provides precision exposures to the market leaders. Jason's approach is focused on sort of local Chinese stocks and sort of a different growth curve. What we're both saying, though, is that perhaps the broad-based exposures that folks have thought of for China, whether it's the largest ETFs or whether it's even some newer technology-focused China ETFs, may not be the right way going forward. So I totally agree that approaches are either more active, more selective, and I would put drag in that camp as well, just taking a different spin on it. And to me, again, because of all the question marks that we talked about with China, uncertainty that is going forward, I don't think we can just rely on broad-based indices, whether to have exposure to Shanghai or Shenzhen listed companies or not anymore.
Right, and Jason, I can already smell the emails from people who are saying, well, the problem with owning China A shares is it's not really a real capitalist market. It's not really a stock market the way we understand it, because the viewers will say, I know people will email me, the government essentially controls these state-owned enterprises. Is that correct? Can you explain what a golden share is? I mean, people often message me that the government has golden shares, which meaning they have the ability to actually control ultimately what goes on in these companies. Explain how involved the government is in running state-owned enterprises, and what is a golden share?
Absolutely, Bob. So first of all, inside China, I would say 50% by market cap, right? It's not 50% by name, but 50% by market cap. It means some of the biggest listed companies are state-owned enterprises. Then there are often state-owned banks, state-owned insurance company, big state-owned power and utility. Those are not super exciting, and generally in an active portfolio that I manage, Dave would agree, will have low exposures to state-owned enterprises because, as Dave, as you mentioned, the government in these state-owned enterprises have the golden shares, meaning they might float shares and U.S. investors could buy them and you'll receive dividends, but the government has more voting power than you do. But that's not very unique, right? In the U.S., I think if you think about Meta, Facebook, and Mark Zuckerberg has golden shares in a way that he, while being a very minority shareholder, has the majority of control. This is true in China with these golden shares. It just means when it's a big state-owned enterprise, the government, even though it might be a 20% shareholder, would have the majority control right. Now, again, we're quite careful in terms of oftentimes avoiding or be extra cautious with state-owned enterprises because, again, sometimes they're just big dividend payers, but there's not a lot of growth because of the government intervention.
So your point is, so for example, you might have a company where the government owns 20% of the float by market capitalization, but they have 70% of the voting power. Is that your point? You seem to be drawing an analogy. It's kind of like Meta and Mark Zuckerberg. I'm not entirely sure that's the same thing necessarily, though, or it's necessarily that benign. Is this true, by the way, of so-called private companies? For example, Alibaba or some other company that is not a government-owned enterprise?
So in the case of Alibaba, interestingly, Jack Ma has the golden share, meaning I think Jack Ma is 4% of the company, but he has majority control. So it's similar from a corporate governance, and if you're concerned about that, yes, it's the same concern. But Bob, you are right in the sense, like, you would believe Jack Ma to be, highly competent, so you might want him to have the golden shares and have the control right. Or you might say, well, Beijing, is Beijing really the best person to be running, even if it's a big state-owned enterprise? Should Beijing have, 90%, 80% of basically the controlling votes?
Right. And Jason, this is coming at a time, what I find interesting, when many ETF providers are launching emerging markets ETF ex-China. They're excluding China from the emerging markets. and we can put up one here, EMXC. And I know you've told me it is a mistake for global investors to exclude China, regardless of the politics. Very briefly explain why it is a mistake to exclude China.
Yeah, so our shop also has a EMXL China. Now, to do ex-China, I would say that's not about eliminating China out of your portfolio. To do a EMX China is because China is so large that you don't want your EM to just be China, right? If you just keep China in there, China sometimes is 30%, sometimes 50%, depending on how it's performing. So XL China gives you flexibility to overweight or underweight China, just like you take US out of the global portfolio, otherwise US would dominate the global portfolio and you wouldn't be able to see Japan or UK. The reason why it's a mistake to take out China is, similar to what Dave has mentioned, China is so big as an economy, right? It contributes, I think, to 20% of global GDP growth, right? It is almost the size of the US in terms of the sheer size of the GDP. And it's on a different phase in its growth trajectory. And its per capita GDP is still growing quite rapidly. You want to participate in that, right? You want to participate in their growth, which is very uncorrelated with the US growth. And that's great for your portfolio. It's another way of buying different demographics, different production function, different risk premium. And then I think as a careful investor, if you're well diversified, it's a great way to build a better portfolio.
Right, participating in growth sounds good, Dave, but it's not the same as participating in stock market gains. China has had growth, but not stock market gains. That's what drives investors a little bit crazy. And Dave, this is a good moment, I think, to remind everyone that China investing is very confusing because you're dealing with really almost three different kinds of investments here. You got mainland China, you got Hong Kong, and you have China stocks that trade outside of China, like Alibaba that trades in the US and now also in Hong Kong. And there's different ETFs for all of them. And folks, we've gone over this many times. This is one of the reasons ETF Edge exists. You can sometimes get very different outcomes depending on what parts of China's investing landscape that you are looking at. So, for example, the iShares large cap at the FXI, which is the oldest one, it's 20 years old, those are all Hong Kong stocks. There's the MCHI, which is the broadest one that's out there. That's Hong Kong, China mainland, and US stocks. KWEB, which is China internet stocks, includes US listed shares. Dave, I guess the point here, I'm putting up a screen here, I don't know if you can see it, is you can get a lot of different outcomes depending on which China ETF that you're investing in. Now, the one you've chosen here that you're using is essentially 9 large stocks. But can you address that sort of difficulty of trying to figure out what kind of ETFs or what kind of China you want to invest in?
Yeah, no, you're absolutely right. And so we've seen the expansion of EMX China. We've now seen the expansion of a multitude of approaches to accessing China, and all with different nuances. And again, that was one of the theses of us launching Drag, was that even though there's already a lot of options out there, what was missing was the precision to just the largest leading companies. And so for an investor, for really any ETF, but especially when you're picking a sector or industry in the US, or in the case of China, you really need to know what you own, do your homework, understand what the outcomes may be. Don't necessarily be rear view looking, because really most of them have had challenging performance in the grand scheme of things, especially relative to the US. And going forward, again, if you believe in the stimulus, believe in an opportunity to access an undervalued China, many of them actually may be attractive solutions for you. But for the case of our ETF Drag, you're just going to have exposure to 5 to 6 stocks, 9 right now, that are the market leaders. Many of them are actually listed in the US or have very liquid ADRs in the US.
All right. This has been a very interesting conversation. We're going to have to leave it there, folks. That does it for this week's ETF Edge. My thanks to both Dave and Jason. Now, we've asked Dave to stick around and tell us a bit more about the future of the Magnificent Seven. This is in the U.S. and his Magnificent Seven ETF. That's coming up on the ETF Edge podcast. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.